Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. Like so many other aspects within the wealth management space, investment management strategies have evolved greatly as markets and client demands change. Well, I am lucky to have on an industry expert who can help us understand this evolution and dig deep into more modern approaches. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. I've already talked enough. Let's go ahead and move on to the star of the show. I am honored and very excited to welcome Scott Ladner. Scott is a Chief Investment Officer at Horizon Investments. Scott, thank you so much for coming on. It's an honor to have you on. Really excited about this conversation. Can you please tell us a little bit more about yourself and Horizon Investments?
Yeah, sure. Hey, and thanks, Brian. And look, first off, I really appreciate the opportunity to speak and be on your podcast. It's it's got a great following, and you do a great job. You're a pro, so
Thank
this makes
you.
it sort of easy on guys like me. And look, this is Horizon Investments. We've been around for about 25 years. We are a goals-based investment manager, and so that means that we have both model portfolios, and we have our own ETF trust. We have our own mutual fund trust. We do, tax loss harvesting activity inside of separately managed accounts for higher net worth individuals. So we kind of do most of everything. We are largely, I would say, probably largely a systematic shop with respect to, systematic equity selection, systematic derivatives portfolios. We do some stuff with fixed income, but we're, our specialty is really more on probably more the global macro and the systematic investing side. My background personally, I'm a recovering derivatives trader. So I was a vol trader for a long time for banks and hedge funds, both for equities and for fixed income. Started at what was then First Union back in the 90s, and sort of matriculated around different hedge funds and prop shops in Chicago, New York, Charlotte, and finally settled back down in North Carolina in the mid 2000s to start my own hedge fund. And through that process, ended up meeting the guys at Horizon and doing a joint venture with them and sort of merging our businesses together, over time. And so I've been around for at least at Horizon for 15 or 20 years. Been the CIO since about 2016 or so.
Awesome, Scott. I love the backdrop. I had a couple conversations with their Horizon investment team. Great team. Love the team you guys have created. They're doing a lot of great things. They're exciting stuff over at Horizon. So congratulations. You know, for years, financial professionals they focus on the nine style boxes, that equity nine style box when creating investment portfolios. When I started in the industry, aging myself here, Scott, 20 some years ago, that's all it was just make sure you've got investments, you cover that whole box, the nine styles, you're good to go, you're diversified within US equities. What is your view on that nine style equity box? And do you feel maybe it's time to graduate, move on, evolve from that and take a more modern approach to investment portfolios?
Yeah, look, so Ryan, I don't think there's anything necessarily like evil or wrong about the style box approach. If you think about really kind of what it was when Morningstar invented it all those years ago, it was really sort of an organizing principle. Before that really existed, and before Morningstar really sort of came along, there were thousands of mutual funds out there, and nobody really had any idea how to think about them. Like how do I compare? Like how do I decide what to do? Which one to invest in, or kind of how to choose a manager or even a fund, because they're not, these things aren't necessarily named exactly for what they exactly do all the time. And what does the Magellan Fund invest in? Like, I don't boats. Like, I don't know. Originally, like the style box idea is, I think, was actually a very helpful thing for investors in terms of just like helping them get a framework for how to understand this landscape of investable mutual funds. I just don't think that necessarily, though, that it is the way that folks today are sort of going forward really need to think about organizing, their investment portfolios. I mean, it was never really meant as a way to design portfolio construction or to design a portfolio. It was really just meant to help as an organizing principle to try to make sense of this sort of unorganized landscape, 30 or 40 years ago. But today, we have other ways to understand that. And if I'm talking to, I'll just use my mom, for example. I mean, if I'm talking to mom, like, mom doesn't really care how much small cap value is in her portfolio. it's not a meaningful conversation to her. It's or how much Japanese exposure does she have? It just doesn't really care. It doesn't move the needle. It doesn't make her sleep well at night. It doesn't really help her understand is she on track or off track. And so that talking to mom in those types of terms, in terms of exposure types of conversations, just I don't think really furthers a relationship between an advisor and their client. It doesn't help in the understanding or sort of the why is this fund or why is this strategy inside my portfolio? It doesn't really, they just don't really connect with that very well. And so I just think there's other ways we can think about organizing portfolios and having framework for deciding what should be in mom's portfolio at the end of the day, and what is a basis for a meaningful conversation with her.
Scott, that's fantastic. You are exactly right. And what I really like using the style boxes for is doing research within Zephyr, is like you said, but you know, looking at peer analysis, right? And like you said, it helps categorize, helps, organize a whole universe of strategies. You can put them all in large growth. It makes it much easier to do analysis, peer analysis, and see how, a fund stacks up to its competitors. So it's a great way. I love the way that you explained it. And like you said, it isn't a bad thing, but, expand your thought process there. So that's fantastic. So if you don't use style boxes, a lot of people creating portfolios, they might use a satellite approach, factor analysis, factor based. What's your recommended solution, or what's your solution of choice rather than style boxes when you're creating investment portfolios?
So, again, and I do, factor exposures or kind of style box exposure. These are all helpful understanding tools for financial advisors to use in order to, to construct on a well balanced and diversified portfolios. It's not form the basis for a conversation with mom about is she on track or off track, really, right? And so when we're thinking about conversations, and we're thinking about portfolios for individual people, that am I good? Mom just wants to know, am I good? That is, that sort of means that we need to have little bit of a different starting place when we think about the portfolio construction, and probably frankly a different starting place when we talk about performance management or performance measurement. Is this portfolio doing the right job? Is doing what we need it to do at this time? In order to do that, Ryan, you got to define the problem. You got to find what is the point of this portfolio at the end of the day? Are we just buying stuff to buy stuff because we're supposed to have equities and bonds and whatever else? Or is this portfolio pointed at a particular problem? Is it trying to solve a problem for mom? And most of the time with it, most of the problems we're trying to solve is mom's got this she's investing money for a particular reason. A lot of the time, the bulk of the money is there to fund a retirement at some point, right? That's sort of the big, that's everybody's sort of big goal out there. Is everybody's got a retirement problem. Everybody's got a retirement plan sort of in place. You might have other things you want to do. You might want to buy the boat or pay for the grandkids' school or whatever else it is. But everybody's got the retirement problem. And so when we think about what is how do we design and manage portfolios, it really needs to be in furtherance of aligning them with whatever the goal of the portfolio is meant to be doing. And that just means that, a slightly different way of thinking about how we construct portfolios, and why do we choose different types of investments, and why do we choose different investment techniques, given what the point of the portfolio at that point in time is meant to be doing for mom.
Scott, that's fantastic. Do you think that's often overlooked sometimes, and just focusing on what is it, what's the problem it's trying to solve? Instead of just, here, let's try and put a bunch of investments in a bucket and try and create the best Sharpe ratio, right? Create the best Sharpe ratio, hope for the best, and we'll go with it, versus really sitting down and thinking of, what are we trying to solve here?
Yeah, and really, what we think that most people, if we're talking about a person's investment problems, we think there are basically three of them. It really kind of boils down to people are either trying to accumulate/grow wealth, they're trying to protect it, and they're trying to spend it. It's really more one of those three things. That's kind of all we're trying to do. And so if you think about what when we talk about goals-based investment management, really what we're talking about is defining define the problem that we're trying to solve, And we really do think it's kind of either, growing assets, protecting assets, or spending them. But doing that inside of a framework that understands that time is a really important variable when we're talking about investment, like an investment theory or investment sort of portfolio construction technique for an individual. Because if you think about what's the big difference between mom and her pension plan? One of these things is an individual, the other one's more of an institutional type of idea. And the chief the chief difference is one of these two things is going to die. There's a finiteness to one of them. Hopefully, just one of them. Hopefully, mom's pension plan doesn't go away. But ultimately, we know that one of these two things, we know that at least one of them has a finite time that they're on this earth. And so when you think about the starting place for an investment philosophy or an investment technique, it does start with this idea of if the investment problem is always and everywhere, maximize return for some unit of risk. That's what I call the golden equation of investment management. It's I need to be maximizing return for some unit of risk. And we sort of crossbreed that with this idea that, hey, listen, we need to incorporate time into the idea of forming this portfolio. You walk away with the thought that, for an individual, the goal or sort of the primary objective for their portfolio changes through time. Right. I mean, so, we are, mom's portfolio is should be doing something fundamentally different when she's 25 years old than when she's 75 years old, which is a super trite and obvious thing to say. And is also I think pretty important, because if we recognize that the primary objective for mom's portfolio changes through time, then I'd also argue, Ryan, that the primary metric that we use to define risk also has to change. And so if that kind of golden equation of investment management is basically max return or objective over risk, goals-based investment management in our framework is really just the recognition that the definition of the numerator and the denominator, the definition of objective and risk, change through time and in a fairly predictable way. And that's, that once you recognize that sort of construct, or that sort of framework, the rest of how you need to kind of solve the portfolio construction problem at least starts to fall out and make a little bit more sense.
Scott, I'm so glad you brought up how we view risk. I have a lot of these conversations, think about it a lot. At Zephyr, we've really thought about what is really the risk of investing. To me, just in a broader sense, the biggest risk isn't volatility, isn't, standard deviation. Give me all the upside volatility you want. It's losing money. That to me is the biggest risk of investing, is losing my investment, losing my assets. And how do you view risk? Like you said, it changes. So are there different metrics you use as they go along? Maybe standard deviation, then more loss prevention analytics and risk?
Yeah, I mean, 100%, Ryan. You've identified it exactly right. Right. So, look, for 25-year-old mom, so let's just put this in the context of a retirement problem and just make it sort of tangible. 25-year-old mom, if we're talking about a retirement portfolio, look, time's not really a binding constraint, right? I mean, it's, we're talking about a 40 or 50-year problem at that point. Time for a 40 or 50-year problem, time doesn't really matter. We can kind of ignore time. And so when we think about what is the definition of objective and risk for that first stage, what we call gain at Horizon, but basically just I need to grow my assets, I need to make money. We're basically solving an institutional type of problem. It is what you talked about earlier. It's basically the Sharpe ratio maximizing problem. And we define risk as volatility there, just because time doesn't really matter in a 40 or 50-year problem. It's just not a binding constraint. And so, the objective is make money, and the risk is volatility. It's just like a Sharpe ratio maximizing kind of thing. But when we get to that middle stage, though, Ryan, we're talking about, what Prudential used to call the retirement red zone, right? I mean, I'm 2 or 3 years away from retirement, or 5 or 6 years away from retirement, or from just needing the money in general. At that point, we all know, then, everybody listening knows, you're exposed to a lot of sequence return risk then. Losing money at the wrong time for something like that is a big deal. And so, at that point, then the risk shifts from something that's being more, more volatility based to exactly what you just talked about earlier. It is losing money, and by the way, it's not losing money. It's not just losing money in a relative sense. It's losing money in an absolute sense, right? I mean, if the market's down 40, and mom's portfolio is down 30, how happy is mom if she's trying to retire in 3 years? Does mom recognize that you just produced 1,000 basis points worth of alpha? It's an amazing investment outcome for an investment geek, right? Yeah, mom's pissed, and rightfully so, because that's not what she needs at that point in her life. That thousand, she doesn't view that as 1,000 basis points of alpha. She views that as I'm down 30, and it's devastating and doesn't know what to do. Right. So that, so the risk for that protection client, we define it as maximum drawdown, which, as I'm sure all of your viewers know, is just like, peak to trough losses over a 12-month period. But that's how we think about risk in that middle stage, that protect stage. And that's, that does like make things a little bit different as you think about portfolio construction and management. But right, like when we get that last place, when we get to like the place where mom needs to spend the money, and and so the primary objective is spending money. I say it all the time, but like if the primary objective is spending money, the primary risk is not having it. Right? It is not the standard deviation of log returns. Like mom cares not one little iota what the sigma of her portfolio, like if what any sort of like Greek letter is like on anything on her statements. She doesn't care. She just wants to not run out of money. And so if you start with the sort of like what that portfolio is meant to be doing for a retired person is maximize the chance that basically maximize the amount of money they can spend while minimizing the chance that they're going to run out of it, or equivalently maximizing the amount of time they can get that check while minimizing the chance that they're going to run out of it. Dude, you end up with a very different type of portfolio construction and very different type of thing than you would if you were trying to minimize volatility for a 75-year-old person. And because in our construct, like here's the thing that will like probably get people's ears a little bit. The riskiest investment for a 75-year-old person in retirement is bonds. It's cash. It maximizes the chance you're going to run out of money. Like if you take it like to the absurd part of the argument, if you just have an entire cash portfolio or an entire bond portfolio, I can tell you to the day on which mom needs to die. Like you better be dead by this date because otherwise you're going to run out of money. Like your money's gone. Like that's it's an absurd thing to say, obviously, but it just helps drive the point. Like how you think about the risk of the portfolio, like the thing you're really trying to solve has a lot to do with what ends up going in it and how you end up managing it through time. And it doesn't always lead to super intuitive outcomes relative to like how we were all sort of trained in this business, right?
Scott, that's awesome. And I love that example of base risk when they're retired is cash and bonds, a thing that they probably look to most, right? They safety, cash, bonds, but there's a risk there, like you said, and outliving. People are living longer than ever,
That's
right?
absolutely
So
right. Yeah,
y-
you've got to be able to drive longevity in the investment process for a retired person.
yes.
And bonds are just not the way to do that.
Yep, exactly. So with gold base, we talked about the denominator when you're looking at, the risk metrics and building that investment portfolio over time. How about the numerator though? Typically, like we'll continue to pick on your basic risk return metrics like the Sharpe ratio. It's just, risk, excess returns. Excess returns and the numerator with goals based, you add another level to that because otherwise it's just, again, we're going back just to returns and let's get the highest returns. But with goals based, do you add something more to that in that consideration?
Yeah, we do, Ryan. And we think about it a little bit as like building blocks, right? I mean, so, by the way, making money like never doesn't matter, right? I mean, like all the financial engineering associated with either retirement portfolios or protection portfolios, it all gets a lot easier if I'm making money. Just take the silly example of like somebody that starts with like in a protection problem, somebody starts with $100,000 and grows it to $120,000. Like my sort of engineering around protecting 100 grand just got a lot easier just because we have gains. And so that hints at like one thing that we do think is pretty important. Like you do need to get in gains in your portfolios on all three stages at all times. Gains always matter. It may just not matter the most. It may not be the primary or the only thing we're seeking to do. So, for instance, in that protect stage, the thing actually I think that separates us most in how we manage money and for people in that stage of life is the recognition that gains are an incredible risk management tool. Like investment, getting too conservative at the wrong time, like gives up right tail gains. And that is, again, gains can't be the only thing you're going after, but if you're sacrificing gains that are available to be had, just to become more conservative or to basically put more money in cash or whatever it is, we think you're not doing that person, the best service because, like protecting the money is the primary objective for a protection portfolio. It's got to come it's got to come first. But gains are a great risk management tool, and I think they're a very underappreciatedly great risk management tool. So we do think all those things sort of like they all come in together. You gotta rank order them in terms of like what's the most important at a given time.
And that probably, like you said, any given time, and then also within each individual client
Absolutely right. Yeah, and that's really part of the advisor's job, right? Is to help guide, like and help inform, like what how should we be thinking about this, mom? Like, is are we, when are we planning to retire? What else do we want to do? Do we want to leave legacy wealth? Do we want to do we want to help pay for the grandkids college, or like what other things do we want to do in our life with this portfolio? And that, those types of discussions, those types of conversations aren't something that obviously Horizon Investments are going to do. Like our job is to try to like take the results of those conversations, which is basically a financial plan, and provide like investments, strategies and solutions that can power that financial plan or be associated with it or productize it in some way. Just make sense of like, I've got this set of cash flows, this set of goals. What the heck do I buy? And like, how do I have a portfolio that matches my financial plan and makes sense not only to me but to my end client? And, that is so I can have meaningful conversations about like, are they on track or off track? And importantly, if they're off track, what the heck are we going to do about it? And just sort of develop a plan together where they feel comfortable and they feel involved, and they don't feel intimidated because you're not using Greek letters or things that they don't understand in order to describe what they've got. Because like, making somebody feel dumb is never a very good sales tactic.
You're exactly right. Exactly right, Scott. And I'm glad you brought that up about that conversation between financial advisor and mom and their clients. Because, like you said, and I'm sure there's some clients that love to talk about the return distribution and
Yeah, the engineers, we
omega
all know.
kurtosis and skewness. Not very many, but maybe there are some. I have a feeling this conversation, and it could be as easy as the Sharpe ratio, can be confusing to a lot of clients. I have a feeling this conversation between financial advisor and their client is a lot easier when they look at it more of a goals based investment management strategy philosophy and talk about goals, how you're achieving the goals, how is the performance, based on those goals versus let's just try and reduce left tail risk and just the analytics and the betas and sigmas.
Yeah, and look, I mean, it's probably it just sort of dawned on me, but like, this it seems to me like it might be a little bit like, like if coders. So like, so people that write computer code for a living, are very good at a particular, they're great at syntax, they're good at structuring sort of logical flows of things. And you can talk to a coder about their code all day long, but like, and I'm like, I can brute force some code, but I'm horrible at it. Like I'm just like disastrously bad at it. And I, like, I don't think I'm a dumb guy. Maybe I'm a dumb guy, but I don't think I'm a super dumb guy. And I could talk to a coder for like 3 minutes and they are speaking their language and I don't understand a word they're saying. And they'd be talking about the simplest darn code in the universe. And like, I'm just lost and makes me feel silly. It makes me feel dumb. And I like, because it's not my world. Right. But now, like now, what can Cloud Code do now? Now you can talk in a normal language. Like Scott could get up on Cloud Code and like try to write a couple paragraphs about some app I want to build or something, and like it'll produce like 1,000 lines of code that I don't understand a lick of it, but the result is I get, and I can have a conversation with the Cloud Code and be a little bit like that, like be helpful about it and not feel silly and dumb, and I'm still getting the result I want and I get it. Like I kind of view like financial advisors as sort of like that AI engine. Like you can be the translation mechanism between what a client really knows they want. I mean, like at the end of the day, they kind of know they just want to be okay, right? They want to, yes, they want to make all the money in their world and all that, but they primarily just want to generally be okay and feel safe and feel like they understand things. Like you're sort of like the advisors to me like a little bit about their Cloud Code. I mean, like they're the translation mechanism between this very complex world of investments with all this complicated math and everything else that goes on, and the translation of the client that just wants, like I know I got a gut feeling for what this thing should be doing and what it should look like and how it should behave. Just make that work for me, okay? I kind of think that's where one of the biggest sort of value adds I think advisors can have for their clients.
You are exactly right. And I often talk about financial advisor is the hub or the center of influence and have all these other, partners, but being able to like estate planning, they might not be an expert in estate planning, but they can explain it to the client and why it's important or tax planning. And they are a very important piece of that overall puzzle that can get very complex quickly.
Absolutely right.
Yeah. So I think we've talked a lot about goals based investing. So this question, we probably answered it already, but why? Why should financial advisors consider more of a goals-based approach to investment management versus some others?
Look, I think it provides a helpful framework for how to think about what clients' portfolios are meant to be doing at a given time. I mean, and it provides a common language through which you can have conversation with clients that is not intimidating, is not full of jargon, is accessible, and will frankly engender trust because the clients know that they're talking about something complicated. But if they're able to do it in a non-complicated, non-intimidating way, that is it engenders some trust because they know that you're sort of like dumbing it down is not the right word. It's translating the complex into something that is that into a language that is more understandable and more accessible to them. That is not in a world that is not their expertise. Like this, like if they were experts in finance, they probably wouldn't be talking in the first place, right? It is you're really your value add is like translating these complicated finance concepts into things that are accessible to otherwise like very smart and educated people, but it's just not their world. And so, and goals-based investing is sort of the techniques and the framework that we can provide for folks is, like is helps basically be a bridge between, between those two worlds. And that is really ultimately what we're trying to do for folks.
Yeah, that's great, Scott. One, I like to use the KISS acronym strategy. Keep it simple, stupid, especially when I'm talking to a programmer. Using your example earlier, as a programmer at Zephyr is like, Keep it simple. Keep it simple." It's going to go over my head, or a mechanic.
No,
Keep
no
it
doubt.
simple, stupid. Yeah.
No doubt.
And so that's great. What then is the objective of goals-based investment management? Is it just to solve a problem, get to between point A and B? What's the overall objective?
Yeah, really, the objective is fundamentally to like be able to take a financial plan and produce an investment portfolio that matches it. I mean, it really is just sort of that straightforward. Like, how do we take all the complication and all the sort of the nuance that's inside of a financial plan and build a portfolio that is connected to it in a meaningful way and that we can track in a meaningful way that is that makes sense to all parties involved. So that's it's look, I could probably make it more complicated than that, but under the KISS acronym, like I could probably just leave it there too.
That is perfect. And that's what it should be, right? It's just starting with that financial plan, that investment policy statement. It's all about alignment. Alignment. I don't think we talk enough about
No, that's
aligning.
I think that's a great word, and I wish I thought of it right.
I didn't think of it either. I just hear a lot of guests talking about it. So I just kind of steal what everyone else says. But yeah, that's perfect. So, you know, it's hard to believe to some of our listeners, but I do a little bit of research about the company, what you guys are doing in Horizon Investments before we go live. You guys talk a lot about three principles of goals-based investment management. What are those three principles that you really focus on?
Look, it is aligning portfolios with the individual. It is managing the money in a way that is consistent with those principles, and it's a proper definition of the objective and the risk for each of those identified stages for folks, and doing that in a repeatable way, in a way that's this is a concept I haven't discussed here yet, but the way we manage money at Horizon, what like sort of like one of the primary things we're trying to achieve is this concept called expectational certainty. And the expectational certainty just means, listen, given a given sort of market scenario, I've got to be able to tell a client or tell my advisor clients like this is the kind of market that this portfolio will do particularly well in or particularly poorly in. If you think about just the simple like, hey, I've got an up market, a down market, and a sideways market. You can usually design an investment strategy that get two out of those three right. It's rare that you can get something that is you probably run the other way if somebody says I got something that get all three of those right at all times. Those things don't tend to go well through time. Those are usually back tests that are more fictional than fact. But if I can identify like what under what circumstances will this investment strategy do particularly well or particularly poorly in, at least I can communicate that, and so that we can align expectations. I can use that word again between the advisor and their clients, between the advisor and us about like, hey, listen, this is what you should expect out of these portfolios, and be able to deliver that on a repeatable basis. Like we think it's an incredibly important thing and trust building thing actually we can do sort of across the entire like spectrum from the end client all the way to us.
Great. So let's talk about that from the end client to you. The financial advisor sits in the middle to really make this successful, make it a successful transition from financial plan to investment strategy, and make sure we're going to use that word again, alignment there. In those initial discussions for the financial advisor, when focusing on an individual, what should the financial advisor really be looking for? Obviously, the numbers, the financial plan, it says what it, but is there anything else that when focusing on that individual, that end client, is there something that the financial advisor should be looking for that maybe the financial plan doesn't necessarily address?
I think like one of the hardest things I think financial advisors have to do and figure out is the like investor scarediness. So I mean, everybody has risk tolerance questionnaires, and we all know that investors lie. So they're going to answer it. Depending on when you take if you took this in 2017, when there's nothing going on in markets and just straight up and to the right, you answer a risk tolerance questionnaire differently than if you took it in October of 2008. And so like sort of the context of that matters. And so I think like one of the things that the financial advisors, probably a skill set that they develop through time is really sort of uncovering like what does this person really think? What do they really like? Like how are they really going to behave if things really kind of go off the rails? Just in markets, not necessarily just the portfolio, just in markets. Like are they going to be this kind of investor that is particularly scared, or really what kind of wants to go to cash, or like what am I dealing with here? Because somebody that if you detect that they are that kind of individual, like you probably put them into a protect portfolio earlier than you otherwise would, because there's a mechanism there to like help deal with some of the downside stuff. And so maybe your transition sort of matrix through through those stages, maybe maybe the timing of those things it gets varied based on how you uncover like through time, or just with your expertise and sort of wisdom. Like what is like how much does this person lie on their RTQ, because we know they're all lies.
Yeah, you're exactly. It's so spot on, especially now. Markets over for the past 3 4 years up 15 20% a year. It's easy to forget about risk, and we talk about it, we call it the reproposal. It's time for financial advisors, and you said it spot on, reevaluate that risk profile during different market cycles, because right now the end client, they might not be worried about risk. It's like, why am I worried about risk? Markets just keep producing 20%. They always just go up. But you might want to sit back down with them and bring them back down to earth. And it's like, markets can drop 50%, right?
Yeah.
And reevaluate.
Yeah, and the other one that is more acute now than it was even 5 or 10, maybe not 5 years ago, but certainly 10 years ago, is like people's political leanings have a lot to do with their outlook on things. And these things make no sense, because if you hated Reagan and you decide not to invest, you were wrong. If you hated Bush and you decide not to invest, you were wrong. If you hated Obama and you decide not to invest, you were wrong. You hated Clinton, you can go down the entire list. Like you're always wrong. If you decide, I hate the president, therefore I will choose to make my investment strategy based on that. Like you're just wrong. The president's not that powerful, really, at the end of the day. But especially relative to the U.S. economy. But I do think that's at least a conversation that I'm seeing advisors having to have much more often now, is like either talk people down from the ledge on either side of that ledge. Like either like nothing could possibly ever go wrong, or nothing could possibly ever go right because of this person that happens to occupy the White House on this day. Those are challenging conversations, because they get emotional quickly. But being able to decouple the emotion from some of the logic of that, like I actually think is like increasingly an important job, and increasingly like a very valuable job for an advisor to have right now. Is like this is one they had to deal with 10 years ago, but this is 2025. Or
Yeah.
26, whatever year it is.
Yeah, exactly. That's a very good point. Do you remember Liberation Day, when everyone thought, oh my gosh, emerging markets and overseas with all the tariffs? Ever since then, emerging markets, overseas, the EFI, fantastic investments.
The screamers, right? Yeah, you got it.
Yeah, awesome. So, last thing here is, objectives, goals based investment management. A lot of it's goals, obviously, objectives. Those objectives change over time. How does that impact the overall objective of the investment strategy? And you've kind of touched on it here about risk, having that conversation about risk. Has the risk profile changed? How often should the objective be reviewed?
Look, I mean, probably every couple of years, but I mean, the objective will sort of reveal itself, as you continue to talk to clients, and as they're, because clients' objectives are going to change through time too. I mean, they're going to have different wants, needs, and desires. Like when their grandkids are 3 than when they're 12, or and same thing with kids. Like you just figure some more stuff out about what you really want out of life and what you want to be able to fund or kind of use your money to do as as life happens around you and as circumstances change, right? And so like just reviewing that stuff fairly regularly, but having a consistent cadence about it, and having a common framework that we can always kind of sort of go back to, and a touch point, sort of an anchor point that we can use to start those conversations. Does help them make be much more consistent, and sort of not get off the rails as quickly as we're just trying to start fresh every single time.
That's great. Lastly, how does the Horizon team apply goals-based investment management? You guys have obviously it's philosophy, strategy. Do you have a big team? How do you apply it?
Yeah, we've got about 20 folks on the investment side, and ranging from everything. We've got our math PhD geeks. We've got guys like me that are ex derivatives guys and ex vol guys. We've got fundamental stock pickers, and a bevy of CFAs. We got our rates guy, like interest rate and bond people. Foreign guys an expert in foreign exchange. And so we sort of like just run the gamut of different expertises. Building that team for me over the last 10 or 15 years has been fairly intentional in that way. Like I just want to have a bunch of different starting places for analysis. So I want like a lot of different types of experience sets. I don't want a whole bunch of small cap value guys all looking at the world the same way that and coming up with the same conclusions, because if your starting place is the same and your training is the same, you're probably going to come with fairly consistent and the same types of investment conclusions. You're going to see the same stuff in the same way. And what we're trying to do is like not do that to the best of our ability, even though that like group things always going to happen sometimes. But if you have a lot of different starting places, then you have at least a better shot to have a more robust investment process and investment team in terms of their views and their sort of the research output. And that's really like we're very intentional about that. And that's what we're trying to sort of continue to build here.
That diversity in thinking is very important. So those investment meetings that I'm sure you have, a lot of different thoughts, just makes the investment strategies more diversified, better. And
And those meetings are a heck of a lot more interesting. Let's be honest.
yeah, exactly. Exactly. Scott, awesome. Awesome conversation. Thank you for sharing such great insight and coming on the show. It was a lot of fun. I love having these conversations about investment strategy, risk. Some people might think that's odd, boring, but I enjoy it. It
Not
was
for us,
such a
Ryan. Not
fun.
for us.
Yeah, great. I love it. Where can our audience get more information about Horizon Investments?
Oh, probably the best way is this the good old website, right? I mean, horizoninvestments.com is where where you find all of our stuff, and sales coverage, all that kind of fun stuff. But it's always a great starting place. And Ryan, I appreciate again the opportunity to speak to you and your audience. You're a pro, makes it easy.
Thank you. Thank you, Scott. I appreciate it. Let's have you on again. We'll talk more. Love it. So, Scott and everyone else, thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.